My name is Darren Joseph from HTJ.tax, and we're the team that seeks to demystify the sometimes confusing world of international tax. And today we have the honor and privilege of having another conversation with Mark. Mark, could you introduce yourself?
I'm an advisor to the entire financial industry on CRS, FATCA, and CARF, and I've advised the OECD and the EU Parliament and the EU Commission and the German government, etc. All this is on my website for anybody to look at.
Fantastic. Deceptively simple question, but it causes so much confusion because there's so much misunderstanding in this space. Mark, could you talk us through, from your point of view, what is FATCA?
FATCA stands for the Foreign Account Tax Compliance Act. And this wasn't the first attempt to dislodge bank secrecy, especially with Switzerland. Switzerland with the diamonds that were smuggled in the toothpaste, etc., and the whistleblowers proving billions by UBS was hiding American money. But Switzerland's European neighbors, in the years even before the EU Savings Tax Directive, which was the first exchange of information, or withholding, tried to undo the laws that facilitated tax evasions by their citizens. They exerted government-to-government pressure, but this pressure went nowhere because the Swiss domestic constituencies, namely the financial industry, and banking is a major financial industry in Switzerland, staunchly opposed any concessions. So the European neighbors' outrage eventually waned, and they shifted their political demands to other matters which Bern was willing to make. But the pro-secrecy constituency, meanwhile, remained steadfast in their opposition to bank disclosures. So what changed? In 2012, FATCA came along. The FATCA was enacted as part of the Hiring Incentives to Restore Employment Act of 2010, but it didn't go into effect until July 2014. And FATCA consists of 5 parts. Only the first part is relevant to this interview. That's increased disclosure of beneficial owners. And that is actually enacted in the IRC. FATCA also refers to the final and proposed U.S. Treasury regulations adopted under the statute. And people think that there's no update to FATCA, but there's additional IRS interpretive guidelines, IRS frequently asked questions, FATCA intergovernmental agreements between the US and 100 countries, local legislation, regulations, guidelines adopted by the various countries. Well, it's not just that the party demanding concessions, the US, which could swing a bigger stick at Switzerland, rather it was the US knew where to aim that stick. Rather than plead with Bern for negotiations, the threats of diplomatic countermeasures, the US enacted a law in FATCA that would impose crippling costs on Swiss banks and their clients investing in the US markets. And those crippling costs I'll answer in the next question. That is, unless Switzerland agreed to let them participate in FATCA, and those banks and those customers were now part of a globalized financial industry, and being penalized for investing in the US would be fatal to the banks. Accordingly, the banks started petitioning their government to end Switzerland's bank secrecy for their US clients, rather than thwarting any efforts to do so. It's interesting that FATCA really started aiming at Switzerland before extending around the world. This pattern of enforcement continued until FATCA entered its operational phase. Under FATCA, the banks and other financial institutions, they function as a deputy sheriff for the IRS. To preserve their own good standing under FATCA, financial institutions must identify and reject non-compliant customers or risk withholding on all their clients' U.S. investments. In fact, many non-bank financial institutions first learned of FATCA only when their bankers started insisting in 2015 that they comply with FATCA documentation obligations or face the forced closure of their accounts.
I think, Mark, that's really important that you said the wider context, that there's been a lot of chatter around exchange of information, secrecy, generally speaking. From a US point of view, we've had the Bank Secrecy Act since the 1970s, 1970, I think it was, which mandates all US taxpayers to disclose accounts overseas. But within the US, of course, legislatively is based on a system of checks and balances. Yes, you disclose financial accounts in the US, but the US financial institutions also tell the IRS, which is the competent tax authority, what you're doing. So there's a check and balance from both sides. Internationally, there was a state of disequilibrium where, yes, you report what you were doing internationally, but there was no counterparty. There was no check on what you're saying. So there's no way to verify really that you did or did not have accounts outside. It was not a big issue politically in the 80s. In the 90s, as Mark pointed out, there were some leaks. For example, I remember the Liechtenstein leaks around 98, 99, somewhere about. Then it became on the political spectrum, but still there was no affirmative action until, as Mark pointed out, in I think it was 2008, Bradley Birkenfeld, former UBS employee, walked into the DOJ office in the US. He's a US citizen, but was working in Switzerland. He took a plane, he walked into the DOJ, the Department of Justice office, and said, "Hey, my former employer is helping US taxpayers, not with tax avoidance, with tax evasion. And here's the proof." It was literally unprecedented. Then the political will kicked in. And I think it was under President Obama, we had the 2010 FATCA legislation being enacted. That, I think, creates a nice way of setting the scene. And with that, Mark, thank you very much for the pleasure of your company and sharing your insights. And if someone wants to reach you, what's the best way to find you?
The best way is just to go to my website, which is co-ownershiptrust.com.
Thank you very much, and we'll see you next time.